We still think the market can move higher in 2024. We do think it's going to be a little bit of a different year from last year, which was characterized by an enormous gain and a very narrow market. So this year, probably more muted gains, but a broader rally. So we're thinking about what are the parts of the market are cheap, which were left behind in 2023. That includes areas like energy, some of the industrials, some of the healthcare. So it's not as if that the long-term themes around big tech have gone away. They haven't. We still think this is a sector you want to be overweight, but maybe use some of the overweight that you had last year to fund opportunities in some of those value areas that are really looking cheap in a market that most people view is rather expensive.
Russ, what's the overall animal spirit, the underlying nominal GDP that's going to drive this economy forward?
I think it's about 4.5%, which is an important number because, one of the things that happened last year that buoyed the market was that earnings held up. And they held up because nominal GDP held up. If you think about the year we're looking at in 2024, let's call it 2% growth. Maybe inflation normalizes back to 2.5%. There's 4.5% nominal GDP. Well, that's a year where you probably can hit or maybe even exceed the 10 or 11% earnings growth that's baked into the market. Right. So I think when you ask why is the market going to go higher after such a spectacular 23, I think that's the main reason.
Russ, what are you seeing with cash right now? Do we wait to see the money market fund trillions move, or is it happening right now?
I think it's starting to happen, but, it is it's a trickle, and it's something that's going to take time. People, Tom, as you know, for the first time in 15 years, we're able to sit out in cash, get a decent return. Today, not only is it a decent nominal return, it's a decent real return. So when I speak to advisors, when I speak to clients, that money is coming out very, very slowly. But as we get into the middle of the year, as we start to see the Fed begin to lower rates, I do think you're going to see more flows into spreads, into equities, into assets that are going to maintain that yield in an environment where rates eventually are going to start to come down.